Okay, so this is Dr. Gold for video number 2. We left off here in the last video looking at Starbucks Corporation at this table and other information related to the company. So I wanted to just go into a little bit more detail about some of the terms here and data points that will be important for you to know. Again, just as a refresher, we have up here the stock price of Starbucks Corporation and then some information below it. Specifically, we have down here something called beta. Now, beta is an important term for you to understand because it is a measurement of how volatile or not a particular stock is. So volatility, which basically means how violently does a stock go up or down, is viewed as a risk factor by investors. So typically, an investor that has an aversion to risk or somebody who's conservative in their investing will tend to want to purchase a stock with a low beta or a low level of volatility, whereas somebody who has aspirations for higher potential rates of return, and potential is the key word there, will typically sway toward higher beta stocks or investments. So what is beta exactly? Well, beta compares the stock price and the movement of that particular stock price against the S&P 500, something that we spoke about briefly in the first video. So when a stock has a beta of 1, and we see here that Starbucks has a beta of less than 1, when you have a beta of 1, it means that the stock will move in exact proportion to the market overall. So if the market's up 10% and your stock has a beta of 1, then your stock should be up 10% as well. If the stock market's down 10% and your stock has a beta of 1, your stock should be down 10%, or you can expect it to be down 10%. If your stock has a beta of less than 1, let's say 0.5, then that means it's less volatile than the market. So it will go up less than the market and it will go down less than the market. And therefore it's viewed as a less risky stock. It's not necessarily a predictor of whether or not a company is undervalued or overvalued, but rather a predictor of how the stock will perform relative to the stock market overall. Typically, what you'll find is companies that are mature, that have been around for a long time, that are growing at a slower rate, will have a much lower beta or much less volatility because they're inherently much more stable corporations. Examples of these types of corporations would include Coca-Cola, Procter & Gamble, Colgate, McDonald's, and so forth. Companies that have been around for a long time, that have a very, very stable financial track record and are less volatile. On the flip side, companies that have betas that are over 1 will typically be newer, higher or high-tech, faster-growing kind of companies. These are companies that inherently are much more risky to invest in, but will reward investors much more if things go as planned. Off to the right of beta, we have something called the market cap valuation. A market cap is simply one way to value a company, and it's calculated by taking the stock price, which in this case is $79.13, and multiplying it by the number of shares outstanding. When you do that, for Starbucks, you get to $59.2 billion. Now that data point alone really isn't worth all that much, except when you look at Starbucks compared with another company within the same industry, and we'll do that in a moment. The price-earnings ratio here is 29.2 times earnings. That means that the stock price is selling at 29 times its earnings per share. See earnings per share here? How can we confirm that? Well, we can get a calculator out and we can say 79.13 divided by the earnings per share, 2.71, equals 29.2. So that's how we get to the earnings per share, and it's an indication of how much ahead of the earnings a company is selling at. The higher the PE ratio, typically the riskier an investment is because it's moved up quite a bit relative to its earnings. The last thing on this screen that we'll look at is the dividend and yield. Dividend is a dividend payment is a sharing of the profits that a company distributes to its shareholders. Sometimes it doesn't come from profits, but traditionally it does. And in this case, we'll see that Starbucks pays a dividend of $1.28. It's important to note that not all companies pay dividends. Some companies like Starbucks do, and other companies like Twitter, for example, does not. The reason why someone would invest in a company that does not pay a dividend, like Twitter, is because Twitter is growing at a faster rate in terms of its sales and revenue than is Starbucks. Starbucks is a much larger corporation than Twitter, but people are banking on, when they buy shares of stock in Twitter, that eventually Twitter will begin to earn a lot of money based upon its fast sales growth. So they're willing to forego a dividend payment in exchange for that potential growth in the stock price. Other companies don't pay dividends because they're in financial duress. This happened back in 2008 and 2009 when we had the financial crisis. Many companies, to save money, had to eliminate their dividend payments because they could no longer afford to distribute profits to shareholders. So next to the dividend dollar amount of $1.28, which basically means that for every share of Starbucks that you own, you get $1.28 per year. The percentage to the right of it is called the dividend yield, and that's basically like the rate of interest that you're getting on this investment. If you buy one share of stock, yes, the stock price could go up, but you're also going to get a dividend payment on top of that. So how is dividend yield calculated? Well, you take the dividend dollar amount of $1.28 and you divide that into the stock price. And you get 1.61. So again, it's the dividend amount divided into the stock price, and that gets you to what the dividend yield would be. Dividend yields are important for investors because investors sometimes only want to invest in companies that pay dividends, while other investors don't want to pay or invest in companies that pay dividends. So that's the end of video 2. What we'll do in the next video is we'll explore this section over here, which is the chart of the stock price of, in this case, Starbucks Corporation, and we'll learn how to use this charting feature, how to compare it with other companies, and so on and so forth. So that'll be in video number 3.